Not every advisor wants to utilize model portfolios, and some really appreciate the ability to manage money on their own, and we continue to create more strategies to really expand the advisor toolkit. Um, and as we previously talked about, the industry has really seen an explosion of advanced strategies, with many of them being actively managed. And in fact, about 78% of ETF launches in 2024, Tom, you mentioned that something like over 500 were actively managed. And active ETFs can really be broken down into what we'll say is like three main categories here. And you can see the slide here. The first is really around alpha seeking. These are strategies that are really seeking to outperform a certain benchmark. And I think what we all think of when we hear active, active alpha seeking ETFs make up almost 80% of the active ETF industry by AUM. But as we talked about on a few slides ago, sort of like, somewhere in the middle, maybe it's less clear that it's traditional alpha seeking strategies, but you have here in the middle what we'll call outcome oriented ETFs. And this is a rapidly growing category within sort of the active strategy space for ETFs. Now, these types of ETFs can help investors achieve a specific goal or an objective like income or downside protection here. And I think a great example of this, of an income-focused ETF, would be a covered call or buy right strategy that'll use options to generate additional income. Where another example here is downside protection, which can be obtained via, we'll call them buffered products, which will utilize options to really help mitigate and define parameters around potential losses. Now, the third category here of active ETFs really focuses on those that provide more niche exposures, which can be more difficult to index. And we think areas like this are like liquid alternatives, or even an example of that is managed future strategies. So really active doesn't mean one thing. There's the category within. And so thinking about how, what is right for you and how you approach building a portfolio is critical, but this should help provide a little bit of context around not all active is just simply seeking to outperform an index. Maybe it's achieving an outcome or hard to index exposures. Now, if we can move to the next slide, Tom, I will turn it back to you. I know this is a passion of yours, as we discussed around asset location, but again, another critical tool as you think about building an entire portfolio.
Yeah, so a pet peeve of mine is when I see an investment diagram of the investment process, and they typically all start the same, basically assessing the market, assessing your client, really knowing your client, and then putting those two pieces of information together to create a strategic asset allocation. And then the diagram typically moves immediately into security selection or fund selection. But they're missing a very important piece along with asset allocation, and that's asset location. So just like real estate, in investments, location, location, location. Location is critical. So Danny mentioned that tax drag that's almost 2% on portfolios over time because of taxes. And so it's very important to consider which assets are placed in which type of accounts. Some assets are more appropriate for tax deferred accounts or tax exempt accounts. Others are more appropriate for taxable accounts. So, for example, let's say that you have a high yield bond fund that's going to be generating a large amount of ordinary income. If that's in a taxable account, then that's going to be paying taxes at upwards of 38.5% all in when you consider the highest marginal rate along with the investment tax that's put on top of that. On the other hand, if you put that into a tax deferred account, then that's going to be deferred until the future, and you're not going to have to pay those taxes today. REITs also generate a lot of ordinary income. If you're using an overlay, for example, covered call strategy, that's going to generate a lot of ordinary income that's going to be taxed at the highest marginal rate. On the other hand, if you have an index ETF that's a broad-based index that's paying very little in dividends, while it may make sense because you consider that to be your highest yielding asset, it might seem to make sense to put that into a tax deferred account so you can defer all those gains. Well, guess what? Those gains are already being deferred because they're not paying out a lot in gains over time. And so it makes sense to consider where you're putting that money. If you take and put a buy and hold ETF, an index ETF, in an IRA, then when that ordinary traditional IRA, when that money comes out, guess what? It's not going to get taxed at the capital gains rate. It's going to get taxed at ordinary income rates when you take it out of the IRA. So you have to look at tax rates for ordinary versus capital gains now, and how that income is going to be treated in the future. Basically, an IRA, a tax deferred account of any kind, is going to take potential capital gains or qualified dividends and turn them into ordinary income when they come out the other end. So a very important step in the portfolio process, the investment management process, is asset allocation and then asset location. So there's a lot of strategies out there. BlackRock has what's called the fill first strategy, which is what we're showing here on the screen. So fill up your tax exempt and tax deferred accounts with ordinary income investments, particularly those that are higher returns relative to others, REITs, taxable bonds, covered call overlays, before allocating those to your taxable accounts. They're going to be taxed as ordinary income anyway, but now we're deferring it until a much later year. So we're getting to reinvest that money along the way. And then anchor your taxable accounts with the low yielding buy and hold ETFs and index mutual funds as well, due to their tax efficiency. Your active mutual funds, you're going to want to put primarily in tax exempt and tax deferred accounts, and particularly if they are ones that are paying out a heavy capital gain distribution as a percent of NAV. And this is where a lot of advisors can add value. There's a number of studies out there. Danny mentioned the 1.86% tax drag. It's somewhere between 1% to 3% that you can add alpha for a client by both asset location as well as doing things like tax loss harvesting, which is also an effective strategy using the wide variety of flavors of ETFs that are available today.